Bitcoin just crashed below $70,000. As I'm recording this, March 19th, 2026, Bitcoin printed a low somewhere between $69,300 and $69,500. That's not a rumor. That's not clickbait. CoinDesk confirmed it. Bloomberg confirmed it. The Federal Reserve confirmed the catalyst yesterday. And if you don't understand what's happening right now, why oil just exploded, why the Fed just went hawkish, and why Bitcoin is getting absolutely wrecked, you are going to get caught completely off guard. So stay with me, because in the next 15 to 20 minutes, I'm going to break down every single piece of this puzzle. The Fed decision, the oil shock, the geopolitics behind it, the on-chain data, and what smart money is actually doing right now. If you're new here, hit subscribe. We cover crypto markets like nobody else. Let's go. Let's start with the raw facts. Bitcoin was trading near $74,000 to $76,000 just days ago. As of this morning, it dropped to a session low somewhere between $69,300 and $69,500. That's a decline of roughly 4 to 5% in a matter of hours. On high time frames, it's even more significant. We are now testing a critical support zone that the market hasn't revisited in weeks. According to CoinDesk, and you can see this article right here on screen, Bitcoin slipped to $70,000 as oil surge and Fed pause weigh on risk assets. That's their headline from today, March 19th, 2026. This is not opinion. This is fact. Now let's look at the chart on TradingView. Pull up the 4-hour. You can see exactly where the selling began. It started right after the Federal Reserve's statement dropped Wednesday afternoon. The candles are clean. There was no ambiguity. Institutions read the Fed, they read the oil market, and they hit the sell button. Now, here's what makes this move particularly painful for bulls. Over $500 million in leveraged long positions got liquidated in the last 24 hours. $500 million wiped out. Derivatives data shows that futures open interest across the entire industry dropped significantly, anywhere from 5 to 9% depending on the exchange. That's a massive flush. Ethereum wasn't spared either. ETH dropped to around $2,160. Altcoins were hit even harder, with thin liquidity amplifying every move to the downside. The market was positioned for continuation higher. The market was wrong, and here's why. This is the smoking gun right here. The official Federal Reserve statement from March 18th, 2026. The FOMC, the Federal Open Market Committee, voted 11-1 to hold interest rates steady in the range of 3.50% to 3.75%. No cut, no hint of a cut. And Jerome Powell, in his press conference, explicitly flagged rising energy prices as a new and significant risk to the inflation outlook. The committee's own projections now point to just one rate cut for the entirety of 2026. Let me say that again so it sinks in. The Fed chair went on camera and said, oil going up is an inflation problem, which means they are not cutting rates anytime soon, which means the dollar stays strong, which means risk assets, stocks, crypto, everything, face a major headwind. Now let's break down why this matters so much for Bitcoin specifically. For the past 2 years, the crypto bull thesis has been built, at least in part, on the expectation of Fed rate cuts. Lower rates mean cheaper money. Cheaper money flows into risk assets. Bitcoin goes up. That was the playbook. And it worked beautifully from late 2024 through early 2026. But now, that playbook is being torn apart. Look, before we continue, let me make this clear. Obviously, this video is not financial advice. I'm sharing my vision and strategy, but you are the CEO of your own capital. Never risk money you cannot afford to lose, as the markets are engineered to be volatile. Do your own research, keep your emotions in check, and only play the games you are prepared to win. Now, let's get into the DAT. When the Fed pauses, especially when it pauses citing inflation concerns, the dollar strengthens. We saw DXY spike immediately after the statement, and when the dollar strengthens, Bitcoin historically faces pressure. It's not a perfect inverse correlation, but it's real and it's powerful. The NASDAQ 100 futures dropped after the Fed decision. That might seem small in percentage terms, but crypto amplified that move by 10 to 15 times, as it always does. Here's what makes this particularly hawkish. 1. The Fed did not cut, despite market expectations leaning toward at least one cut by mid-2026. 2. Powell's language was careful but firm. He acknowledged economic growth is holding up, which takes pressure off them to ease policy. 3. The new wildcard is energy, and that brings us to the most explosive part of this story. While you were sleeping, or while you were watching Bitcoin charts, the energy market had one of the most violent single-day moves in years. Brent crude oil surged to somewhere between $114 and $119 per barrel across different sessions, up 6 to 10% in a matter of days. European natural gas futures surged as much as 25 to 30%, reaching above $78 per megawatt hour, 25 to 30% on natural gas in Europe in one session. Why? Because of what's happening in the Middle East right now. Israel struck Iran's South Pars gas field, one of the largest natural gas fields on the planet, shared with Qatar. Iran launched retaliatory strikes targeting Gulf energy infrastructure, including sites around Ras Laffan, one of the most critical LNG export hubs in the entire world. This is not a small skirmish. This is a direct hit on the arteries of global energy supply. Bloomberg, and I'm showing you their article on screen right now, confirms that this is what triggered the energy surge. They draw the direct line. Geopolitical escalation in the Middle East, energy prices explode, risk assets sell off globally. Now let's connect the dots for Bitcoin. First, rising oil prices are directly inflationary. When it costs more to fill up your gas tank, heat your home, and ship goods across the world, inflation goes up. And as we just established, inflation going up means the Fed cannot cut rates. That's a direct headwind for crypto. Second, energy costs affect Bitcoin miners. Mining Bitcoin requires enormous amounts of electricity. When energy prices spike, mining becomes more expensive. Miners who are already operating on tight margins get squeezed. Some will sell their Bitcoin holdings to cover operational costs. That creates additional sell pressure on spot markets. Third, the macro risk-off environment. When geopolitical tension spikes, when missiles are flying and energy infrastructure is burning, institutional money runs to safety. They buy dollars. They buy gold. They sell equities. They sell crypto. This is a proven pattern, and we saw it play out in real time today. Think about what just happened in a 24-hour window. The Fed said no rate cuts. Oil surged 6 to 10%. Natural gas exploded 25 to 30% in Europe. Over $500 million in Bitcoin longs got liquidated. BTC dropped from near 74 to 76,000 down to below 70,000. This isn't chaos. This is cause and effect. And once you understand the mechanism, you can start to think about what comes next. Hey, pause for a second. If you're still here, right in the middle of this breakdown, that already puts you in a different category than most people watching crypto content right now. Seriously. While everyone else is doom-scrolling Twitter and panicking, you are sitting here trying to actually understand the mechanics behind this move. That's the difference between someone who survives a crash and someone who gets completely wrecked by it. So respect. Genuinely, I mean that. Now I need something from you. Drop in the comments right now. Your city, your local time, and what the weather is like where you are. Sounds random, right? But here's why I ask. This channel has viewers from Sao Paulo to Singapore, from Lagos to London, from New York to Dubai. Every single time I drop a video like this, a real-time market breakdown, minutes after the move happens, I want to see the map light up. I want to see who's catching this at 3 in the morning because they never sleep during a crash, who's watching on their lunch break, who's in a snowstorm in Chicago or sweating through summer in Sydney. So drop it. City, time, weather, one line, that's it. And if you haven't subscribed yet, do it right now before we keep going. Because the next section is where it gets really interesting. The on-chain data is telling a story that most people are completely missing right now. Let's keep going. Let's go deeper into what the data is actually telling us right now. On the derivatives side, the picture is clear. Funding rates across major exchanges have flipped slightly negative, meaning short sellers are now paying longs a small premium. That's actually a potential signal of local capitulation. When funding goes negative after a big drop, it often means the most aggressive longs have been flushed out, and the market may be approaching short-term exhaustion on the selling side. Open interest, the total value of outstanding futures contracts, dropped significantly across the board. That's a meaningful deleveraging event. The excess leverage that had built up in the system is being forcibly removed. In the short term, this is painful. In the medium term, it creates a cleaner, healthier market structure. Ether's open interest dropped even more severely than Bitcoin's, consistent with a risk-off environment where capital rotates from altcoins to Bitcoin and from Bitcoin to cash or stablecoins. Now here's what's interesting from an on-chain perspective. Long-term Bitcoin holders, wallets that have been accumulating for 12 months or more, have not been selling in significant quantities. The pain is being felt almost entirely by leveraged traders and short-term speculators. The diamond hands are holding. This is important context. When the so-called weak hands get shaken out by liquidation events like today's, what you're often left with is a more resilient holder base. The people still holding Bitcoin tonight bought it for a reason, and they're not panicking. Support levels to watch. 69,000 is the immediate level. We tested it today and bounced slightly. Below that, 67 to 68,000 is the next key zone, which lines up with the 100-day moving average on the daily chart. A clean reclaim of 72 to 74,000 to the upside would signal that buyers have absorbed this shock. Resistance is now at 74,000 and then the prior high zone near 76,000. The market needs to prove itself before those levels are in play again. Let's zoom out for a second because I want to give you the full picture. We are in a macro environment that nobody expected to look quite like this heading into 2026. Here's the honest summary. The Federal Reserve cut rates aggressively through late 2024 and 2025, and those cuts fueled an enormous risk asset rally. Bitcoin went from below 30,000 to nearly 90,000 at its peak. Ethereum more than doubled. The crypto market cap exceeded $4 trillion. But then, gradually, and now suddenly, the macro conditions shifted. Inflation, which everyone thought was defeated, has been creeping back. Energy prices have been slowly rising since early 2026, driven by a combination of OPEC supply discipline and rising demand from a rebounding global economy. Today's geopolitical event in the Middle East is an acceleration of a trend that was already in motion. The Fed, watching this unfold, made a cold calculation. Holding rates steady is less dangerous than cutting and reigniting inflation. They're right. But for crypto markets, which had priced in cuts, this is a rude awakening. Now here's the critical question every investor needs to ask. Is this the end of the bull cycle, or is this a painful but ultimately temporary correction? My honest answer, and I want to be very clear that this is analysis, not financial advice, is that the data does not yet suggest the bull cycle is over. Here's why. 1. Institutional adoption of Bitcoin is structural. ETF flows, corporate treasury allocations, sovereign wealth fund interest. These are not going away because oil spiked for a few weeks or because the Fed skipped a rate cut. 2. The Bitcoin halving cycle is intact. Historically, the 12 to 18 months following a halving have been the strongest for Bitcoin price performance. We are still within that window. 3. Geopolitical crises tend to create sharp, violent drops followed by recoveries once the initial shock absorbs. Oil price spikes driven by conflict. Think 2022 after Ukraine. Think 2019 after the Saudi Arabia strikes, have historically resolved faster than markets initially fear. 4. $69,000 to $70,000 is still an incredible price for Bitcoin. Perspective matters. A year ago, this asset was trading at a fraction of today's value. The question isn't whether Bitcoin is dead. It isn't. The question is whether you have the conviction and the risk management to navigate moments exactly like this one. So what are the sophisticated players actually doing right now? First, they're not panicking. Panic is for retail traders who over-leveraged at 74 to 76,000 and are now watching their positions get liquidated. The liquidation data proves this. Over 500 million in longs got blown out. Those were traders using 5, 10, 20 times leverage. That is not smart money behavior. That is speculation. Second, smart money is watching the derivatives market carefully. When funding rates go deeply negative and open interest drops sharply, that historically creates attractive setups for the patient accumulator. They are not buying the first bounce. They are watching for confirmation. Third, they are monitoring the macro environment week by week. The next Federal Reserve meeting will be critical. Any shift in language toward potential cuts would be an immediate catalyst for a reversal. Similarly, if the Middle East situation de-escalates and oil prices pull back from these extreme levels, the inflation narrative weakens and the rate cut thesis comes back to life. Fourth, they are diversifying their thinking. Let me give you 2 clear scenarios for the next 2 to 4 weeks. Scenario 1, bearish continuation. If oil prices remain elevated above $100, sustained by ongoing conflict in the Middle East, inflation expectations will creep higher. The Fed will remain hawkish. The dollar will stay strong. In this scenario, Bitcoin tests the 67 to 68,000 support zone. If that breaks, 63 to 65,000 becomes the next major support. This would be a deep but historically normal correction within a bull cycle. Think 30 to 40% from peak to trough, which is completely standard for Bitcoin. Scenario 2, recovery and reversal. If geopolitical tensions ease, if a ceasefire is reached, if Iranian and Gulf infrastructure comes back online, if oil drops back toward $90 to $95, the inflation scare abates. Markets reprice rate cut probabilities higher. Risk assets recover. Bitcoin bounces hard from the 69,000 level, reclaims 72 to 74,000, and sets up for another leg higher. In this scenario, the bulls who held through today's liquidation event look like geniuses in 3 to 4 weeks. Which scenario do I think is more likely? I think the geopolitical situation is deeply uncertain, and anyone who tells you they know exactly how it resolves is lying to you. What I do know is that Bitcoin has survived and thrived through multiple geopolitical crises, multiple Fed tightening cycles, and multiple moments where everyone said the bull run was over. What matters right now is your time horizon and your risk tolerance. If you are a long-term investor with a 12 to 24-month view, today's price of $69,000 to $70,000 may look like an extraordinary opportunity in retrospect. If you are a short-term trader with leverage, today is a reminder of why leverage in crypto is so dangerous. All right, let's bring it all together. Bitcoin just crashed below $70,000. The catalyst is clear and confirmed by Tier 1 sources. The Federal Reserve held rates at 3.50 to 3.75% in an 11-to-1 vote, explicitly citing oil prices as an inflation risk. Brent crude surged to between $114 and $119. European natural gas exploded 25 to 30% in a single session, triggered by strikes on South Pars and retaliatory attacks on Gulf LNG infrastructure, including Rosslaufen. Over 500 million in long positions got liquidated. Open interest dropped significantly across all major exchanges. The macro environment is risk-off, but the long-term Bitcoin holder base is not selling. The structural adoption story is intact. The halving cycle is intact. This is a dangerous moment for leverage traders. This is a potentially interesting moment for long-term accumulators. Okay, if you are still watching this video right now, I want you to understand something. You just made it through 30 minutes of macroeconomic analysis, institutional positioning data. Most people clicked away a long time ago. You're still here. That means something. Comment below with 3 letters. I am still here, John. Not because it is a secret code, not because it gets you anything, but because I want to know exactly how many people in this community have the patience, the discipline, and the intellectual appetite to sit through the mechanism rather than just the headline. I see the diamond is what you say when you understand that the value is not in the price chart. It is in the framework. It is in the structural analysis that explains why the price chart looks the way it does and where it is going next. If you got here, you got it. Subscribe if you are not subscribed. The algorithm buries channels like this one because serious financial analysis does not generate the dopamine spike of a 10-second clip. Your subscription is a signal to the algorithm that there is an audience for work that treats you like an adult. Stay sharp, manage your risk, do not over-leverage, and keep watching markets with the same level of analysis we bring to every single video on this channel. Wait, don't close this yet. I'm not exaggerating when I say this. The average viewer on YouTube drops off in the first 60 seconds. The fact that you're here at the very end of a 20-plus minute deep dive on macroeconomics and crypto market structure, that tells me something real about you. You're not here for hype. You're not here for some guy screaming numbers at a green screen. You're here because you actually want to understand this market. And honestly, that's the only edge that matters. Not the best indicator, not the perfect entry. Understanding, that's it. That's the whole game. Please, don't forget to comment your city and the exact time you're watching this. I want to see the full global map of people who made it to the end. São Paulo at midnight, London at 6 in the morning, Dubai at 9, Tokyo at 2 in the afternoon. Let's see it all. I'll see you in the next breakdown. And stay sharp out there, because this market does not reward the distracted. Ever.